Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today we're talking once again with Joanne Musa. Hey, Joanne.
Hey, Kirk. How are you?
Doing well, doing well. Well, thanks for coming back on the show and joining us today.
My pleasure. It's
an
honor to be here.
Well, good. So we brought you back on because Joanne, as many of you know, is an expert in tax liens, which I think is an excellent area to be looking at in this in our interesting times that we live in. So, Joanne, why don't you tell listeners who haven't heard you before a little bit about your background before we begin?
Okay, well, I'm not a financial expert like you are, Kirk, and that's why I always love talking to you. I got started back in 2002. I had the only house that I had bought and sold was the condo that my husband and I had lived in. So I didn't know much about real estate, but I wanted to get involved in real estate because I really thought that was the way to get wealthy. We had just sold our condo, and we were in a market like the market that we were in a couple of years ago, where houses, things were going crazy, and we couldn't buy anything, not having good credit, and not knowing what I know now, but I knew that I wanted to invest that money, and I had read something about tax liens, and I lived in a state where there were tax lien sales going on all the time. I lived in New Jersey. So I just started going to tax lien sales, and I learned the business the hard way by going to sales, making mistakes. But then in that process, I found out that there were people all over the country and really all over the world who wanted to learn how to do this. And I started my website. I met somebody else who was trying to learn how to do this too, who was a millionaire in New Jersey, had a lot more money than I did to invest. And he actually hired me to help him develop his portfolio. So in the process of learning, I also hired 5 other people to go to tax sales in New Jersey and had to teach them how to do this. And so that's how I learned, and also at the same time started my website and started teaching others how to do this. So that in a nutshell is how I started. And from there, I interviewed people from around the country and made those interviews. At that time, we didn't have Zoom, we didn't have webinars. I did this by teleseminar on the phone, interviewing people from around the country. And I had these free teleseminars that people were able to come on and learn how it was done in different, because it's different in every state. So that was my humble beginnings. And now I'm the tax lien lady.
Well, that's great. Yeah, I know. When I first started learning about it, I'd found you online, the Tax Lien Lady. So yeah, I know you've been doing this for quite some time, which is great. For the listeners who are not familiar with what tax liens are, can you kind of differentiate? There's a bunch of terms that are out there that confuse people. I know when I started, I had this confusion: tax liens, tax deeds, tax certificates. Can you kind of explain the difference and how all that, what all that means?
Sure. And for people out there who don't know what a tax lien is, municipalities and counties rely on money from property taxes to build roads, pay school teachers and civil servants like policemen, firemen, build schools. And if they don't get that money, it really hurts their budget. So what do they do for people that don't pay their taxes? Well, in some states, what they will do is sell those taxes to an investor so that they can get that money in sooner and not have to wait for the delinquent taxpayer to pay. So what happens is they'll have an auction and actually sell this in an auction. Now, why would an investor want to pay somebody else's taxes? There's a lot of reasons why. If you've ever been late paying your taxes, Kirk, the one thing I learned from this business is that you pay your taxes, your property taxes, before anything else, because they charge you through the nose when you're late. In some states, there's interest rates and penalties, and added on. And in New Jersey, it is calculated daily. Okay, in other states, it's calculated monthly, but in some areas, it's calculated daily. So you can wind up owing a lot of money if you're late paying on your taxes. So the investor gets that, they get the return on their money when the delinquent taxpayer pays their taxes. So you could get high single-digit, double-digit returns even without the risk of the stock market, because it's the real estate that backs up that tax lien certificate. In some states, you actually get a tax lien certificate, which is a piece of paper that usually has a stamp and a seal on it, and it's signed by the tax collector or county treasurer. In other states, they just give you a receipt, but you basically have a tax lien certificate. And if you don't get paid, if the property owner doesn't pay within a certain amount of time, each state has a different period that they allow them to pay. It's called a redemption period. Then if you have that tax lien certificate, you get to get the property, you get to foreclose on the property. So that's generally how it works. There are different nuances in different states. That's what a tax lien is, but not all states sell tax liens. My state, I live in Pennsylvania, they don't mess around. They're a little bit impatient about getting their money, and not only getting their money, but returning that property to somebody who's going to start paying the taxes. So they will sell your property right out from under you if you don't pay your taxes. And that is a tax deed. Investors are actually bidding for the property at those tax sales and getting a deed to the property. Okay, so that's the difference between a tax deed and a tax lien. Does that answer your question?
Oh, absolutely it does. No, I appreciate it. I think it's very helpful to get that difference, because I think people throw words around and they don't always understand the difference. So let's kind of dive right in, because I know we talked, and we'll put a link to the prior episode we had you on for listeners who want to dive into more about tax liens and tax deeds. But, I know the market has changed. The real estate market has changed a lot because interest rates are going up. And, we've had a good run for pretty much the last 20 years, especially the last 14, where interest rates have been close to zero. So what are you seeing that's changing now? Because things are fine, and then this year things have changed. So what are you starting to see?
Well, what I'm seeing is in the real estate market. It's not in the tax lien investing and tax deed investing market yet, but that lags behind what's happening in the real estate market. So I see that there is going to be some great opportunities. What I see happening in the real estate market in different markets in the country is that it's no longer a seller's market. From the other people that I'm listening to, I see areas where houses are staying on the market longer and no longer being sold right away, no longer being sold for over the asking price. Now there's even price cuts on some houses in order to sell them. And there's starting to be more available on the market. When I say more available on the market, I don't only mean new builds and houses in the retail market. I mean also bank-owned properties. For a long time, there was not a lot of bank-owned properties on the market, and that drove investors into the tax deed sales to try to get these properties at a decent price, because they weren't able to buy these bank-owned properties. So it kind of drove the price of these deeds up, and now real estate investors were paying a lot of money to get these deeds. Well, I believe that is going to slow down. I believe it has already started to slow down, and that in the next few months, there'll be a great opportunity to buy houses cheaper at these tax deed sales. There will be more available on the market, more in the sales, and the competition won't be so ready to bid prices up so high. They're going to start curtailing how much they want to pay for these tax deed properties, which will make it a better environment for new investors.
So you mentioned that the tax deed, tax lien market tends to lag the real estate market. Do you happen to know like how much of a lag or what that would look like? Because interest has gone up a lot.
Yeah, and that is what's going to help the tax lien market, because what happened with the tax lien market is a little bit different than the tax deed market. What happened with the tax lien market is we had a lot of hedge funds jump in to the marketplace because it was a way that they could get the return on their money without worrying about the stock market, a little more secure because there was real estate backing up their investment. But when the rates go up, there are other places that they could go put their money without doing as much work, without doing the due diligence that they have to do for the tax liens. So what I think we will be seeing, of course, I don't have a crystal ball, but what I think we will be seeing is some of those banks and big fund companies going elsewhere and not being so competitive in the tax lien investing market when they can go other places and do less work and get the higher returns, because they've been bidding down the rates in the tax lien market, getting and being happy with these low rates. Now, even if they stay in the market, they won't be bidding down the rates so low anymore when they could get higher rates elsewhere. So I think there's also going to be a big opportunity in the tax lien market in the coming year to get liens at better rates than last year. Last year was a very competitive year, and it was not a good year in some markets in tax liens.
So I gotta ask you this because I know that you've been around in the tax lien market for a while. The last few years have been a little bit anomalous because people are just looking to put money somewhere. And I think it was very characteristic of before 2008, and it was 2006 or 7, where people were just putting money anywhere, they didn't care. But excluding those, the tax lien, tax deed market, there tends to be a higher premium on these than you would, let's say, like a treasury bond. Do you happen to know, like, generally, like, where that difference is? Are you talking about like a similar yield? Because you said you think they'll go higher. So I'm wondering, like, generally, like, what's that difference look like? Because it's going to cause somebody to want to get into the space as opposed to, like you said, go to a treasury, which you don't have to think, like you just buy it. Okay,
let me qualify that question so that I know how to answer it, because there's actually 2 different bidding processes. There's actually more than that, but there's the main ones are, in some states, the interest rate is bid down, and in other states, there is premium that is paid for liens. So I'm not sure if your question was, is more money being paid for the liens, or are the liens coming in at higher interest rates?
So effectively, the interest rate that you're taking, so whether you're bidding up the price or whether you're bidding down the yield, it's effectively the same thing. Your yield based on the amount you're putting in is similar, even though it's a different process, correct?
Well, not really.
Oh, I'm learning something new today, Joanne.
Only in some states, and I'm going to tell your listeners a little secret about the really good states to invest in are the ones that you pay premium and you get the interest or the penalty on all the premium that you pay. So you're not really lowering the rate that you get by paying more premium. Those are the best states to invest in. So, and it is different. Anybody that says that they're an expert everywhere in the country on tax lien investing is probably, there's only like a couple of people I know that can actually say that, and I would believe them. Most people say that, and they're kind of stretching the truth, because it is so different in every state. I'm not an expert in every state, and quite frankly, there are some states that I wouldn't want to be, because it's really they're not worth bidding in. So anyway, that's one little secret I can throw out, that it is different in every state. And the best states are the states where you don't compromise the interest rate when you bid premium, that you're getting paid on your entire bid amount. So that doesn't always happen.
Okay. So, but I guess that's I appreciate the clarification. But so generally, let's assume the interest rates, like Florida, let's say, because Florida is a popular state, everyone knows it. It's easy in some ways because it's online. Before it was online, I remember in 2006-07, it was like 10-11%. Is I think what the rate was at a lot of the auctions. Like, what do you like? I know it's gone way down, but like, what do you see as like a good yield that would be reasonable in this kind of market?
All right. Well, the thing about Florida is that they have a minimum 5% penalty. So pretty much a lot of the good properties get bid down to 0.25% in Florida. And it was extremely competitive because the fund companies had multiple bids, thousands, even, they could have 100,000 bids on one property. I know that sounds ridiculous, but there were laws to prevent that, but this past year they did away with them. It was called the single simultaneous bidder rule. And Florida did away with that this past year. And they were trying to make it better for these big companies, these hedge funds to invest. And it was extremely competitive. But the reason that they would bid down to 0.25% is because they get the 5%, the minimum 5% penalty. So now, is that going to be good now for them with the change in interest rates? Maybe not. So, but do I see it not getting bid down that low on the more desirable places? Because here's what happens. If there's like a 3-bedroom, 2-family house with a mortgage on it, and they know it's going to get paid off right away, and they get redeemed, and they get their 5% in a month, well, you annualize that, and that's a really good return. So, so it remains to be seen. Now, the tax lien sales in Florida only happen once a year in May. Most of them are done by June 1st. So we'll find out next year what is going to happen in those sales. Now, not all properties get bid down that low. Land does not get bid down that low. So you can get better rates. But when you talked about the rate being 10%, the actual statutory rate in Florida is 18%, and it gets bid down from there to 0.25%. It can be bid to zero, but it's not good to bid to zero. Even people who don't know what they're doing do that, because if they bid down to zero, they're not going to get that 5% penalty minimum. They won't get the minimum penalty. And there's something else that happened in Arizona last year. Same thing. The statutory interest rate there is 16%. It's another popular state with online tax sales. It got bid down to zero. A lot of the properties got bid down to zero. But if you bid it down to zero, you don't get anything. You actually have to pay money to get the lien, because you're going to pay the platform $10 per lien. You're going to pay the county $10 per lien. And then every time you pay subsequent taxes, you have to pay the county $5. And you're only going to get on your subsequent taxes that you pay what you bid at the sale. So you're going to get nothing on them. You might as well not pay them. So you basically have to pay money to get the lien. It doesn't make sense at all to bid down to zero at the Arizona sales. But we saw that happening last year, and I don't know why. So I would imagine that will go away this year, and that these liens will be actually won at a interest rate.
So that was actually going to be the next one on my list, was Arizona to talk about. So I'm glad you kind of brought that up. So what are some of the states that you think are reasonable to consider for, because I know there's some that are really weird. Like I think it's Michigan. It's some weird, you're bidding on a percentage of the house. I think it's Michigan.
No,
Um,
that's not Michigan, that's Iowa.
oh, Iowa.
Michigan tax sales are going on now as we're recording this. I don't know when this is going to air, but they go on in August and they end the first week or two in September. And then they rebid the things that didn't bid the first time. But what happened in Michigan is Michigan last year was very competitive. So I'm anxious to see what's going on this year because it's a deed state. So, and a lot of it's online. Not all of the counties were online last year. And although a lot of them were, but they were online and then they did live sales at the same time they were doing the online sales. So they would basically read out your bids to the live sale if you were bidding online. But with COVID, and Michigan was one of these states that was really shut down, they just did everything online only, and they didn't have any live part of the auction. And it was very competitive because of the scarcity of houses on the market last year. So I'm anxious to see what happens there this year. But they start the bidding at the back taxes and bid up. From there, they're actually bidding on the price of the house. Now, there are some states, as you mentioned, that have a different bidding procedure. They bid down the percent ownership of the property should the lien not redeem and you get to foreclose on it. Iowa is a state that does that. They've done that in Douglas County, Nebraska, which is online. And the other state that does that is Louisiana, which has a lot of online sales. I do not recommend that. I don't think it's good for the investor. But there are states that use that type of bidding procedure.
Yeah, that one, I mean, there's every state's different, and I was reading about that process of, I guess at the time I thought there was only one, and maybe there's three, where you're bidding down ownership. You get a percentage, whatever it was. I thought, whatever reason, it's not Michigan. I thought it was, where it was like you get 20% and up to 50% or some crazy amount, but you're bidding on the percentage ownership, which to me it sounded like the last person I want to be a co-owner with is the person who's not paying their taxes. And that's how it kind of explained as I was reading about it. I'm like, why would anybody interested in that? So I guess I'm curious, like, why a state would come up with such a convoluted type of a setup, and why would it be attractive to investors?
Yeah, that's a good question. I don't know. I don't think the reason that it was attractive to investors when it first started is that some of these states, before they went online, they didn't really bid down the ownership. It was sort of like a random thing. Like in Iowa, you would just raise your hand or raise your bidder number if you were interested in that property, and they would just give it to you. And then if somebody else wanted it, they would yell out 99% or 90, and it would go down from there, 98%. But that didn't happen too often because investors were not willing to do that. But then when things went online, that's the only way that they did these sales, that they just bid down the ownership interest of the property. And now some places, and I have to check Iowa and see if they're still doing that, because I think in some areas, I don't know if it was in Iowa or Nebraska, but one of these states figured out that this is not a good way. So they changed it to where you could not bid down the percent ownership of the property. And it might even be different from county to county. Like some counties might just do a random selection process instead of bidding down the ownership. But I know they still do that in Louisiana. They've tried to change it. Investors have tried to get it changed, but they have not been successful doing that. So, but here's why it might be advantageous to investors. If you find a property that has a mortgage on it and that you know is going to redeem, then there are investors or funds that will bid that down low, knowing that they're just going to be redeemed and get the full amount. And hey, in Iowa, the return is 24%. So, you know, it's a huge return. So that's why people would be willing to do it. They're willing to take that risk. However, even if you bid 99% and the owner has 1% ownership, you still can't sell the property. You still can't do anything with it. So,
Right.
you know, it's a mess.
Yeah, it was Iowa. That was the one. It was this weird setup that wasn't like any other state. I don't know why I have Michigan stuck in my head, but it was, yeah, Iowa was the one I was remembering. So, you know, but looking at this now, you know, there's 50 states out there. How should you look at this? Like, where should people start? Like, where are the opportunities you see if the real estate market is kind of changing now, and maybe the opportunities for investors in this space are coming to pass? Where are the opportunities that you see going to start to come up in this space?
That's a really good question. As I said, I like the states where you bid premium, or basically you bid up the price of the lien and you get interest on everything you bid. And I'll tell you, all the redeemable deed states do that. We really didn't talk about a redeemable deed. We talked about deeds and liens and the difference between them. Well, a redeemable deed, and there's only a few redeemable deed states. And they kind of have the best of both because they're selling the deed at the sale, at the tax sale. But when you buy that, you don't actually own the property. The owner of the property still has a redemption period that they have where they can redeem their property and buy it back. But at these sales, you're actually bidding up the price of the property, and you're going to get either a penalty or an interest rate on the full amount that you bid. Okay, so I think on those states are going to be good opportunities in the months to come.
Okay, interesting. So, okay, so basically people are buying these properties at a discount is really what it comes up to. And if they redeem, which I would imagine probably most of them don't. I mean, what do you, how many of them?
No, most of them do. Most of them do. I mean, with tax liens, 99% of tax liens around the country that are sold are going to redeem. As now, in some areas, it might be it might be lower than that, but in inner cities and in areas that are depressed, it might be lower than that. Also, on certain types of property, like land, might be less likely to redeem. But I'll tell you what, in my experience, there's only one property, well, I would say two in my 20 years of experience where we actually got to foreclose on. And that's liens. Now, redeemable deeds, and well, actually that was one lien and one redeemable deed. But redeemable deeds, in some states, you have a better opportunity of foreclosing because it's harder for the owner, for the delinquent taxpayer to redeem, because they have to come up with not just their back taxes and whatever the statutory rate is, or penalties or interest on that back taxes, but now they have to come up with all the penalties and interest on the overbid, whatever the overbid was.
Yeah, I guess that could add up pretty quick. And I would imagine people who aren't paying their taxes probably don't have the resources necessarily to do it. So what's if you wanted to acquire one of these, what's typically the period of redemption or the period in which people can foreclose? You know, because I know Florida's got a few different dates that you have to be mindful of. So how do people kind of manage that kind of calendar process?
Well, let's talk about the couple of states that we talked about. Florida has a 2-year redemption period. Arizona has a 3-year redemption period. I do not like states that have longer than a 2-year redemption period. Because I believe that's too long. Because, you know, it's quite possible that you're not going to get paid until that redemption period is over. So I like the states that have a 2-year or shorter redemption period. And there are states that have redemption periods as short as 6 months. There's one sale in Indiana that has a 4-month redemption, and there's a redeemable deed state that has a 60-day redemption period. So, you know, the shorter redemption periods I like better. And I like states that have a year. I like the redeemable deed states that have a year redemption period.
All right. Well, as we get close to wrapping up here, Joanne, in the interest of time, what are some kind of final thoughts you can leave our listeners with here?
I do want to just break some of the myths about tax lien investing. I think we've touched on a couple of them. For instance, that you might not get paid until the property owner decides to redeem the lien or pay the taxes. So that's one truth that I want people to take away, so that they know it's not like a CD where you just get cash flow every month or get money put into your account every month. It doesn't happen like that. The nice thing about it is that you don't have to negotiate. In a lot of these states, everything goes through the county treasurer or county tax collector. And another thing, I think we mentioned this, that you know, experts would throw out the term government guaranteed, and people think, oh, they could just go buy a lien and they're guaranteed to get paid. No, you have to do your due diligence on the property. The real estate is your guarantee. So those are the things I'd like to leave people with. And if they'd like to find out more, I can tell them where they can go.
Yeah, where can people find more about you, Joanne?
Okay, my website is taxlienlady.com, and my blog is taxlieninvestingtips.com. I do have a free report. I believe it's on my blog and my website. It's called Tax Certificate Investing, or Tax Certificate Sales Investing. It has a long name, I don't even, but it's a free report, and you'll find it on my website. You could sign up for that. For those of you who really want to learn more, I have a book on Amazon, Tax Lien Investing Secrets: How You Could Get 8 to 36% on Your Money Without the Typical Risk of Real Estate or the Uncertainty of the Stock Market. And that book was written in 2016, but the information in that book is still good today. So even with the changes that have been since COVID, since 2020.
Nice. Well, Joanne, I really appreciate you coming on the show. Always a pleasure to chat with you about tax liens, one of my favorite asset classes. So thanks again for joining us. And yeah, we'll have you back on in the future. I know the market's going to change quite a bit in the future, so we're gonna bring you back on and talk about those changes. So
yeah, I'm anxious to find out myself and to clue you in.
Great. All right. Thanks again, Joanne.
Thank you.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Joanne. Really appreciate her coming back on the show. Always like her wisdom as the tax lien expert in her field. Now we're into the panel portion of the show. So this week we have our very own Barb Friedberg. Hey, Barb.
Good morning. Happy to be here, Kirk.
Glad to have you. And we also have our very own Doug Hagren. Hey, Doug.
Good morning, Kirk. Ready to put a lien against the time that I'm spending on these podcasts.
It'll be well worth it, Doug. It'll be a great payoff for you.
I believe it's a great investment for myself and for all.
All right. Well, let's dive right in. Barb, you want to take the reins this week?
I do. Kirk, I'm going to start with you. What are tax liens for the dummies out here who really know nothing about them?
All right. Well, let's start with this. So anyone who owns a home understands that you have a home, you own it, right? You technically own it, and you have equity in your home. So let's say you buy a house for $100,000 and you put down cash. So you have $100,000 in equity, okay? No mortgage. Now let's say you decide to go get a mortgage, okay? Let's say you get a typical 80-20 mortgage where you borrow $80,000 and you get a mortgage for it. So now you have a mortgage for $80,000. You have equity of $20,000. Okay, that's the amount. If you sold your house today, you'd get $20,000, minus fees and all that. So that's a typical homeowner. Now, if let's just say you decide, I don't want to pay my taxes on your property. Very bad thing to do, but let's just say for whatever reason you're not paying them. Yeah, Florida is a good example. You have these snowbirds. They spend 6 months north, 6 months in Florida. So let's say they don't get their tax bill and it's sitting on their doorstep for 6 months. Well, they owe taxes. So what ends up happening is the state of Florida will put a lien on your house for the back taxes that are owed. It's not the state, technically, it's the municipality. So, but just to be clear. So your taxing municipality will put a lien on your house and it'll go in the registry of deeds and it'll say this amount is owed. Now, so technically, let's say you owe $1,000. So now you have a mortgage for $80,000, you have a lien for $1,000 on your house, and you have $19,000 in equity, technically. Okay. Now that $1,000, you might think, well, the mortgage went on there first. So, the mortgage, if I don't pay any of these people, they foreclose on my house. That's typically what happens in foreclosure. And then they get paid off, which we'll get to in a second. Now, the mortgage, you might think, well, the mortgage was there first, so they get paid off first. Well, generally speaking, with most debts you put on your property, the person who gets paid off, or the entity that gets paid off first, is the one that has a debt on the property first. Okay, so the mortgage would have been first, so they get paid off first. However, it doesn't apply for everything. If you owe the IRS can put a lien on your house. They take superior position to everybody. So if you don't pay your taxes, they put a lien in your house and they get paid first. After that, tax liens, municipal tax liens get paid next. So assuming that there's no IRS back taxes, that lien, that $1,000 lien gets paid off first. Then everyone else gets paid off next. Now there's another layer there, which is condo liens. They get paid off after municipal tax liens. And then it goes, for the most part, it goes whoever is on next. So it's really important to understand who gets paid off first. And this is one of the benefits of tax liens is a tax lien. Let's say the homeowner has not paid their taxes and they want to, they can go pay it off and pay the city, and they'll pay interest on that lien that they own. Now, for the state of Florida, so many snowbirds don't pay their taxes on time, and they have to pay their government employees. So if you think about it, Miami-Dade County, let's say nobody pays their tax liens, right? Or nobody pays their taxes on time. Let's just say, let's say everybody's a snowbird and they don't pay their taxes on time. Well, they have to pay their employees, right? They have to pay their vendors. The only way they're going to get money is from taxes. So what they do is they'll take those taxes that are owed and they'll say, well, we need to get paid today. So we're going to sell this lien to an investor. Now, let's say Doug's the investor. Doug comes along and says, hey, I'll take that. Here's my $1,000. You can pay me, 18% on that lien. Great. That's a great deal for Doug, right? And Doug gets paid 18%. Miami-Dade County gets their $1,000. Everybody's happy. The homeowner eventually pays it off. And when they do, that cash goes to the county, and then the county goes and pays Doug. That's effectively how tax liens work. Now, there's a huge market for these. We'll get into this more, but hopefully that answers your question, Barb.
So 18%, that's unheard of. So
we'll get to that. There's a wide range of yields, and we'll get into that. That's a bigger part of the conversation.
okay, so Doug, let's do this systematically. Where can I get my hands on one of these? And are there disadvantages of these types of investments?
Well, there's absolutely pros and cons, just like there is with any investment. How you can typically get your hands on one of these is that if you were going to go directly, counties publish the information that they have on the different liens that are out there. And the private reports show that this delinquency rate, of course, with the great economy that we've been having, has been decreasing for the past decade. About 6.3% of taxpayers were delinquent on their property taxes in 2021, and this declined to 5.9% as the year went on. The states with the highest property taxes, if you're looking at, would be Mississippi, Delaware, Virginia, North Dakota, Minnesota, Wisconsin, where I'm in Minnesota, have the lowest delinquencies. And you were talking about those snowbirds. And it's interesting because you were talking, one of the things that they actually did here in Minnesota, which I think is probably helping this a little bit, is when I was going to get my mortgage, they offered about a half point or a quarter point difference if you got your mortgage with escrow, as opposed to having the taxes paid separately. I think that avoids that risk a little bit because they know that there's a significant risk that can come from that. Now, where do you go to get them? I mean, as I said, the counties publish them out there for people to find. There's the roughly $21 billion in delinquent property taxes each year, and estimates about $4 to $6 billion are posted for sale to the private sector each year. Now, you can go bid on these, and in many cases, if there are lots of bidders, as she talks about, that's going to drive the competitiveness down. It's going to drive your return down. And typically, Kirk was talking about interest. From what I've seen out there, the interest varies, but typically it's around 10 to 12%. Repayment time typically is going to be 6 months to 3 years on these. But another note is, because of the risks that are out there, there's actually an association, National Tax Lien Association, NTLA. 80% of all tax liens run through its members. They have some ethics requirements. They have some other things that you need to be aware of. And ultimately, I think they can help to give some standardization of the industry. Other than that, there are some private investment groups that can have some sizable contributions, like $100,000 minimums to get into these groups. Investopedia talks about investing in funds, but honestly, in a search out there, ETFs, mutual funds, closed-end funds, there really is not a lot, if anything, that pops up there for the average investor to just simply get into. unless they want to get in directly to purchasing these things outright. And we can get into it. There's some definite risks and pros and cons you need to be aware of.
So let's say I want to do this. I go to the state, I look up the list, I put my bid in, and I get a lien, let's say $1,000 lien.
Mhm.
Now, does that mean I've got to collect the taxes from the homeowner?
Yeah. So yes, exactly. So what's happening is you're buying this lien, hoping to collect this yield. Now, in many cases, it can differ, but in a lot of cases, what you'll have to do is you'll actually, and again, Kirk talked about, the state will get paid off, or the county municipality will get paid off first. In many cases, if you buy this, you're paying the county off, so you have to come up with the money and the interest and penalties to pay them. And then you are looking to collect, again, the yield, the premium. That's why there's a premium in buying it. They're trying to sell this a little bit as a discount to get it off of the county or the municipality's books. Then you get to purchase these, hoping that there's going to be a spread between what you had to pay in interest and penalties and principal on the tax lien versus the ability to collect that. There are a lot of risks, though. There's neglected properties out there that might be in slum areas that may not be a good buy. There could be property owners that are unable to or unwilling to pay the tax owed. I don't have these statistics, but I would love to go back to 2007 and say, as people were walking away from their homes, what was the risk jump on the ability to collect on these things, right? Because we may be going into a situation now where, again, there may be a sizable number of people who just are going to be unwilling to pay these. Also, you have to worry about environmental damage, chemicals, hazardous risk. It's not a passive investment. You got to notify property owners in writing of the purchase within a stated amount of time. You have to send often a second letter of notification near the redemption. So people are looking for passive investments. This is not it. Also, there's competition. Again, as we mentioned, as more companies or more investors try to jump in to buy these things, it can drive down the return that you can get on that investment. And there's actually limitations. Tax liens can expire. They're not everlasting instruments. Many of them have an expiration date after the redemption period. And once that expires, the lien holder becomes unable to collect on any unpaid balance. The property goes into foreclosure. They may also discover that there are other liens on the property that can eat away at what they were able to obtain. So definitely important to know what you're doing when you're getting into these things, especially if you're going to use your money and go in directly and try to buy these outright.
So it sounds like you need to really educate yourself if you want to get into this asset class.
Absolutely. A lot of the things that Kirk, has had conversations with on the show have been around some sort of a passive investment, right? I think there's a conversation around buying collectibles and things like that. You buy them, you hope you just kind of sit on them, and eventually they might have value. As we've discussed ad nauseum in other conversations, real estate people love to talk about real estate as a passive investment. I would argue it's never a passive investment, because if you've ever watched any of those shows on History Channel that show what happens to a neglected city over 5, 10, 15, 20 years, how quickly the jungle takes them over. Real estate takes a lot of work to maintain. It has a lot of cost to maintain. And if you're dealing with these owners of these properties that are already in significant potential financial trouble, you have to work within regulations and a lot of effort to eventually collect on the money that you're investing to return on.
So it sounds like also lawyers might be involved, and you've got to foot that bill if you need to collect the money and it's not easily collected. Now, Kirk, have you ever bought a tax lien? And if so, can you tell us about your experience?
Yeah, I'll tell you, personally, I have not. And here's what I'll tell you a little about my experience though. So, I did a ton of research, about a year after we started our firm, we did a ton of research on tax liens because, our really our area of expertise is alternative assets in self-directed IRAs. And what better asset to hold in a self-directed IRA than a tax lien, right? So we did a lot of research, found out a lot of really interesting stuff. So for example, one of the things I found out was at the time there were 6 banks that owned a couple to a few hundred million in tax liens. And what was interesting, and this was right after 2008, and I think it was JP Morgan got out of the business at that time because they didn't want to be seen on the front page of the paper evicting Granny from her home. So they got out of their business and sold their portfolio because of the optics. But these banks, these large enough banks, they own a few hundred million in tax liens because they're getting a good yield. And who can blame them, right? They had this whole operation built out. They were able to get liens, get an enormous amount of liens, which this is kind of what we learned. So what we decided was we said, all right, we want to do this. So we went and explored a few people that were doing it. And we talked to them and said, all right, what are you doing? Let's look at your operations, as prospective investors, because we didn't know if we were going to use them or do it ourselves. We figured, let's just learn. So I went to one guy's operations, ran a really tight ship, really good guy. We were going to actually just use him. We figured this guy is putting in a ton of work and the operations are immense. We don't want to do this. He had like 10 people running his operations. He had maybe, I don't know, 50 million in tax liens. It wasn't even like enormous. And I figured, there's no way we're going to do this. It's not what we do, right? We're not a portfolio manager. So we were going to use him. And through the conversations, we realized that one of the problems actually is scale. So there was a time many years ago, one of my interns, I told him about it. He tried it. So he bought like 3 or 4 tax liens, $100 a piece. You could do it. And I advise everyone who's interested to do this first is go to like a state like Florida, go to one of the counties, see what they have on their books. They probably have a few tax liens in their books, look through them, see if there's anything that sticks out. Cost you $100, right? And because they're not auctioned off, like those small ones sometimes, you can get the full 18%. So you can get your 18%. If you lose it, that's the cost of education, right? So Doug talked about some of the risks. I'm going to tell you about some of the risks because I think overall it's a great asset class. It's one of my favorites. The big problem with tax liens, there's a few problems, but it's not necessarily a risk. I think of them more as operational hazards. So one of the problems is logistics. Now, one of the great parts is you don't have to do any of this collecting. You don't have to do any of it. The municipality will do it for you. They'll handle it. They'll handle taking the payments. They'll handle sending out letters. Now, you have to hire attorneys to go foreclose if that's the process you want to take. That's on you. But when it comes to collection and sending out notices, the county will do all that for you. It's really easy. And it makes it easy because if you're a homeowner, the last thing you want is some like vulture capitalist coming in and harassing you at your house. That's not what happens. The counties take care of this for you. You won't even know that they've sold the lien to somebody else, okay, until they foreclose on you, then they might know. But, the reality is this is a good thing for beginning investors because you can do it with a small amount of money. So let's say you have 10 liens. Well, now you have to monitor them, right? So, oh, great. So you gave them your $100 a piece. You gave $1,000. Let's say you're getting 18%. Great. So you're going to get $180 a year for your lien, which is awesome. But think of the work that you have to put in there. Now you have to track 10 liens, which is not a ton of work, but 10 is getting to the number where you have to start tracking this in spreadsheets and you have to put together systems. That's 10 liens. What if you had 100? What if you had 1,000 liens? How are you going to track those? Right. So now, granted, there are systems out there. People have created systems, spreadsheets and tracking and all that. But just think if you had 1,000 liens, how are you going to deal with that? How are you going to hire an attorney to track all these and send out notices? And, it becomes cumbersome. And this is part of the problem. So if you look at these, I mentioned there were 6 banks that had a few hundred million in tax liens. They have the operational procedures to handle all of this. But you and I, we don't, right? And nor do we have the budget. So let's say, you have to go hire an attorney for that $100 tax lien. Well, now you got to shell out money. You'll get it back, right? Assuming you'll either get it back or you get the property. But let's assuming that it doesn't go into foreclosure. You'll get it back, but you still have to shell out that money. So, you've got all of these issues that come into play. So what ends up happening is you can get these $100 liens, but logistically, it's not going to be worth your time. And that's the conclusion we came to, because the other solution is, well, you just get bigger liens. Yes, you and every single other institutional investor are looking for $10,000 liens or more. The problem is there aren't that many of them. So they're all fighting for these $10,000 liens. And so instead of getting 18%, maybe get 2%, maybe get 25 basis points, or in Florida, I think the minimum is 5 or 6. So you get that for 1 year, and then it's 25 bips after that. Is that worth my time? I don't know. I mean, if I'm running a fund, is it worth it? Maybe. But I think the point is when I started doing the research on this, I realized this is not the best use of my time to make that kind of money. Would I do it for fun? Yeah, I've still contemplated doing it for fun just to try it out. But I've kind of come to the conclusion you really need a portfolio manager to do it for you. And, we'll get into this as well. But I think that's my solution to it, is if you want to do it for fun and learn it, it's a great thing to do. You can do it for very little money. There are very few investments you can do with this little money outside the stock market, right? The stock market you can, but outside of that, it's very hard to do. And as Doug said, it's not really a passive investment. Real estate, people talk about, oh, real estate's a passive investment. No, it's not. It's a business. It's an active investment if you're doing it right. Now, if you get lucky and you buy a property and you get a renter who's going to live there for 10 years, great. Okay. Maybe it's somewhat passive, but you still got to cash the checks. You still got to do all these things, hire people. So it's hard to find quote unquote passive investments. I mean, really the best passive investment is like a publicly traded dividend stock, or maybe you have a private company you can invest in that pays you good cash flow and you have to do, you're a passive investor and you have no active role. Okay. That's maybe more passive, although I would argue you probably want to be somewhat active in what's going on. So it's really hard to find quote unquote passive investments. They're passive-ish, but you still have to manage it. So that's the reason I never did it. And people on the show listen to me long enough know this. I love this. This is literally my favorite asset class, and I've never invested in it. And I'm not afraid to say it because my due diligence pushed me away from doing it. And like I said, I still would love to do it because I think it would be interesting and cool, but I'm not going to build a portfolio of this stuff because I just don't have the time or, quite frankly, the interest to manage it with, with attorneys and all the stuff that has to be done. So, even though it's my favorite from a risk to reward perspective, I have to give it a pass personally, unless it's through a fund.
So returns are really good, but the trade-off on the amount of time makes it a very time-consuming investment.
Absolutely.
So Doug, do you have any data on what are the average returns that an investor in tax liens might expect? And then how does this compare with, say, buying a stock or buying an ETF?
Yeah, well, I want to clarify one thing. You mentioned, you said returns are good. The returns can be good. And I think that's the critical thing I think listeners need to be aware of. And because they hear, sometimes they think of these, oh, we can always make money in real estate, can always make money in this. The returns can be good. I mentioned before, it looks like the interest that you can typically get has averaged out to about 10 or 12%. That can obviously be different from place to place. Now, from a how do you profit standpoint, there's about 2,500 jurisdictions. Again, I'll give credit where credit's due. This is information that Investopedia has. So, but there's about 2,500 jurisdictions out there that sell public debt. Now not every state provides for the sale of delinquent property taxes. But if they do, then investors should be able to determine where these taxes are published for public review, and they've got to be put out there for a specific period of time before sale. And they would list the property, the legal description, the amount of the delinquent tax to be sold, which could be one of the reasons this could be a good investment, right? What is one of the number one things that motivates people? In a way, it's kind of public shaming, right? This is one of the few areas in America that we still have, put them in the stocks and throw the tomatoes at them, because you're going to end up in the newspaper, that you owe money, and people don't want that. We say, keeping up with the Joneses, right? There's a saying I have, is let the Joneses win. Because the Joneses love to put on this image of how they're doing, right? And a lot of it's fake, because we hide what's really going on in our financial world. And we know the statistics out there show that if everybody was the Joneses, then the numbers wouldn't show how poor things are. So in that regard, I mean, that could be a benefit to see, to helping to entice this repayment that could make it worthwhile, because people don't want to be embarrassed. And the other thing is they don't want to lose their home. It's typically, it's kind of ironic that banks are so ridiculously stringent on what it takes to get a mortgage in the first place, right? Because the majority of people, it's the last bill they're not going to pay. They might let their electricity get turned off. They might let their gas get turned off. They might let their credit cards just absolutely max out. But the place that they're sleeping, that's their family. That's their home. That is where they are taking care of their loved ones. And so ultimately, the first bill that most people are going to try to pay is going to be for their housing. Okay. And I think that bodes a little bit well on this. But you also have to understand that because of the time frame, because of the upkeep, there's only we're talking about payment. Investors who purchase property tax liens are typically required immediately to pay back the full amount of the lien to the issuing municipality. And that happens in all but 2 states. In all but 2 states, the tax lien issuer will collect the principal, interest, and penalties. Then they pay the lien certificate holder, and then they collect the lien certificate if it's not on file. And then the property owner must repay the investor the entire amount of the lien plus that interest, which, as I mentioned, was typically between 10 to 12%. And if the investor paid a premium on the lien in certain states, that also may be allowed to be repaid in certain circumstances. So that's how you can make money on these things. But as I mentioned, you got to do your research. I mean, even a fund, as Kirk was talking about, I said, there really isn't, if a plethora or many, options at all for your typical investment opportunity, which we think of as ETFs, mutual funds, stocks that might invest in these things, closed-end funds, right? There are some private investments. So if they require you to put up $100,000 of your money to get into them, you have to have $100,000 that you can afford to lose, or at least afford to be incredibly patient with. And that is just not the case for the average investor. Then you also have to do your due diligence. Just because somebody, you need to get educated in this no matter what you do, because just because somebody out there is doing this and you can give them the money and say, hey, okay, I'm going to be passive because I'm going to let them, they're the experts in this field. You need to know who you're getting in bed with, right? They may be doing this, but there is the bodies are long and spread out of dead investment opportunities where people said something was too good to be true. Madoff, right? So, I mean, you have to know who you're getting involved with. And I think that's why so many of these investments end up going through the association, because ultimately that association is going to, the NTLA is going to, give you access to not only the code of ethics, but it's also going to have, various education webinars, certified tax lien professional certification. You can use their online directory to connect with other industry experts. I'm not here to promote whether or not the NTLA is a good association or not. But I do think that, the reason that a lot of these associations came about, why there's the certified financial planner, it just kind of creates at least some standards and practices, and may give you access to both education and other professionals like the attorneys that understand this, that can help you through it. Because if you're doing this on your own, there's a lot you need to know whether you're going to actively be involved or give your money away to have someone else do it.
So as we wrap it up, we've talked a lot about how you go about the tax liens and what are some of the perils. But who is this investment for? I posit that if you're younger, you're ambitious, you're entrepreneurial, and you are willing to put in the time and effort to learn, and you think this is something I want to become an expert in. Now, you only have limited time, so you can't be an expert in everything. But if you decide this is an avenue that I want to pursue, then there are benefits for that. If you're someone who has your plate full with everything else, you want to turn your investing over to a manager like Doug or Kirk, or you want to hire a robo-advisor and you don't want to be bothered, well, then it's not for you. So, Kirk, final words before we wrap it up.
Yeah, final words for me is, I think everyone here knows I love tax liens. It's literally my favorite asset class, but I want to impress upon everyone that it's from a risk to reward perspective for the full yield that you get there. I can't think of a better investment. The risk is comparatively small and the reward is reasonably large. And, there are a lot of good things to like about it, but as I've just, told you all, like I have not invested in it for different reasons. And I think you have to know your own investor psychology and you have to know like what makes sense for you. So, if I was saving $100 a week or whatever a month, let's just say, and I wanted to invest small, this is a great way to do it. It's a great way to learn. It's a great way to get involved. I think you'll hit a point of saturation. Like I said, I have different problems than maybe an individual investor because I'm also managing money for clients. So I can't just do this one small thing and spend a lot of time in it unless it's going to scale. So I need to be able to scale the investments that we do with clients because otherwise, I only have a certain number of hours in the day. So I will tell you that I've looked for good managers and they are out there. Most of them are hedge funds. It's hard to get access for the everyday investor. It is. I've even explored setting up an ETF or closed-end fund around these, as I think the opportunity set is there. It's never come together because the people that were doing it, they didn't see the interest, or I think as Joanne mentioned on the show, there's some issues with the scaling where it used to be able to actually do okay. Because in the past, what would happen is you'd go to your local county courthouse and you'd bid on the liens and you get, 10, 12% or whatever it was at the time. And then all these things are online now. So because they're online, anyone in the world can bid on them, which is a problem because then everyone in the world will bid on them, which means that there's a huge amount of competition, which means you're not getting your 18%. Now the yields range from, I think, anywhere between 6 or 8% upwards of, I think 25% at the highest, but and every state's different. So you have to obviously understand your state rules. I would just say pick a state and just try it out, whether it's Florida, Arizona, or Georgia, whichever one you want, but pick a state and just learn the rules, try it out, start small, just play around with it. I think for a beginning investor, I think it's a great way to learn real estate. It's a great way to learn tax lien investing, and who knows, Joanne's been doing this for decades successfully and she's able to find good deals and I'm happy for her. I think there are people I know that do this on an individual scale, so there's definitely opportunity out there. And I love this. If you have the time and you want to put in the effort, it's hard to beat 18%. I'm sorry, it's hard to beat that anywhere. So yeah, that would be my 2 cents for the tax liens.
Doug, final thoughts, and where can people find you?
Thank you. So I just to kind of state on that, the way I look at investing, if this is something that you want to put your money in, it's kind of like real estate, right? If you want to put your money in a little bit of real estate, it's going to take a little bit of work. And if it's not your full-time job, then you have to ask yourself how you're going to go about it. I always tell people who want to get into real estate, first question, do you want to be a landlord, right? Because it takes that. Well, and the response I'll get, well, I can hire a property manager. That cuts into your margins, right? So that's like using a fund. So
you have to manage the property.
And you got to manage the property manager, right? Exactly. So the way I look at this is, this does not supersede traditional layering of your investment portfolio. Okay. If I use the golf analogy a lot. Now, professional golfers probably argue with me on this, but you can basically get by playing golf with, a driver or a 3-wood and maybe 1 iron, a 5-iron. Then you could have a sand wedge and a putter, and you can probably play a round decently if you know what you're doing. Okay. Now, outside of that, you're going to start adding other clubs, but they're not going to be your main clubs. You might have an Adams tight lies, for that, if you play in the rough a lot. You might have a 7-wood. You might have a gap wedge. You start adding these things. It's the same thing with this investment. You don't build your bag around this, but if you've already built the core tools within your bag, this could be something that you add for a specific niche play. Or you make this a business, like Tax Lien Lady, like Joanne did. You make this something that you know, like real estate investors that they have built a business around, and they understand the risks. They also spend all their time focused on it. Okay, I think those are the two ways that you go about this. So again, if you don't want to spend the time, you don't want to learn it, you don't know about it, at least at this point in time, I would probably not spend a lot of time trying to get involved with this. I do think, Kirk, it's ripe for a closed-end fund. I mean, using the leverage in a closed-end fund to be able to buy up these at volume could be something that could create great yield in a closed-end fund, because that's what closed-end funds are really there for, but it's just not out there at this time. So thank you again, Barb. Douglas Hagren, Pro College Planners. You can find out if you have a child that's freshman to senior, it's going to be going to school here. Find out the game is rigged against you for college. You can go to procollegeplanners.com, download our free report right now to kind of see what college could cost for you and a couple schools that you might be looking at, what that would cost, and also some recommendations. Talk to us, because listen, you may never win this game, but if we can even that playing field, then you might have a chance to get that return on investment on something that is going to be one of the biggest investments you'll ever make.
And I'm Barbara Friedberg. You can find me at Barbara Friedberg Personal Finance, Robo Advisor Pros, or on YouTube at Barbara Friedberg. Thanks. I'll turn it back to you, Kirk.
Great. Thank you both for coming on again. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.